Okay, good afternoon, everyone. We start our committee meeting. As usual, we start with the adoption of the agenda. If there are no objections, the agenda is considered adopted. A reminder about interpretation facilities. Today we have interpretation on 12 languages, and I skip now the announcements which I will make later on in the afternoon, because I want to skip to the point 3 in the agenda, which is our monetary dialogue with Christine Lagarde, President of the European Central Bank. So welcome, President Lagarde. This is the second monetary dialogue in 2023. Our monetary dialogue today is again taking place in a still challenging environment marked by uncertainty and inflationary pressures. While headline inflation has declined, it is expected to be at 6.1% in May 2023, down from 7% in April, according to a flash estimate from Eurostat, mostly due to the ongoing fall of energy prices. However, core inflation remains high, mostly driven by the rise in food and services prices. Flash estimates of Eurostat show a considerable heterogeneity in the rate of inflation. There are some member states in which the inflation rate is already below 3%, like in Luxembourg, Belgium, and Spain, and others in which the inflation is still above 10%. Baltic countries, Slovakia. Focus is also on the contribution of high corporate profit margins on inflation, as well as possible wage developments that might further feed into price pressure. Since the last monetary dialogue on March 20, the ECB's Governing Council has continued on its monetary policy tightening path. The Governing Council, during its last meeting in May, decided to further raise key interest rates by 25 basis points, with President Lagarde indicating that there is still more ground to cover. Likewise, the Governing Council decided on a full passive unwinding of holdings under its asset purchase program, the APP, from July onwards. Furthermore, the largest of the outstanding tranches of targeted longer-term refinancing operations, the so-called TLTROs, is expected to mature at the end of June, with banks having to repay about 477 billion euros. This will contribute to further reduce liquidity in circulation. In this context, two topics were chosen by coordinators for today's meetings. The first one is the interaction between price stability and financial stability, and the second is the effects of high inflation and monetary tightening on the real economy, which we all know is a concern of many European citizens. As usual, all briefing papers prepared by the European Parliament panel of experts are available on the ECON Committee's website. Today, Madame Lagarde is here in Brussels not only for our monetary dialogue, but also for the formal conclusion of an important agreement with the European Parliament for structuring the practices for interaction in the area of central banking, with the aim of enabling the ECB to effectively discharge its accountability and transparency obligations in full respect of the requirements set out in the Treaty on the Functioning of the European Union. As President Lagarde recalled last February, this accountability exercise was largely based on practices, most of which were not explicitly written or codified. But now we have changed this, and I'm really, really happy and proud about the work that we all have done. We have been waiting for a long time. 25 years ago, a Parliament report called for an agreement with the soon-to-be-established ECB, and for over 20 years, no progress was made. But more recently, in this committee, during one of these monetary dialogue, we started to discuss with President Lagarde about this need, and we started with her a very fruitful and productive dialogue. So I'm so pleased that the ECB was ready to engage in this agreement, and I want to thank President Lagarde for her openness and her availability. Please let me acknowledge the important work made by all ECON coordinators, as well as the support that we got from President Metsola and the Conference of Presidents throughout the whole process. As it is now standard practice, there will be an introductory remarks by President Christine Lagarde of 10 minutes, followed by a first round of questions, one slot per political group, longer slots for speakers in the first round of Q&As with the follow-up questions allowed, 1.5 minutes for initial question, 3 minutes for answer, possible follow-up of 1 minute and 2 minutes maximum per answer. And then second round of question where we apply the DONT system, 1 minute for question and 3 for the answer. So I ask you to respect the time given to you. And now I give the floor to President Lagarde.
Thank you very much, Madam Chair, and good afternoon to all of you, members of the Economic and Monetary Affairs Committee of the European Parliament, ladies and gentlemen. It is a pleasure to be with you again, as the Chair said, for the second time this year, and immediately after celebrating the 25th anniversary of the European Central Bank. I'm delighted that some members of the Parliament attended this celebration in Frankfurt a few days ago, reflecting the close and fruitful dialogue our institutions have always maintained. Since the ECB's creation in 1998, members of the Executive Board have attended over 100 hearings before this Parliament. This engagement has been central to the ECB's accountability and has contributed to the euro becoming a currency that our fellow citizens trust. So let us turn our attention to the matters at hand, and let me start by providing you with a brief overview of the economic outlook before going on to discuss our latest monetary policy decisions. Looking at the economic outlook, growth in the euro area slowed, nearly stalled in early 23. Activity is being supported by lower energy prices, easing supply bottlenecks, and fiscal policy support to firms and households. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. The ECB welcomes the European Commission's recommendation to Member States to wind down in 23 the fiscal measures taken in response to the energy price shock. Domestic demand, especially consumption, remains weak. Business and consumer confidence indicators point to weak activity in the second quarter and remain lower than before Russia's unjustified war against Ukraine and the Ukrainian people. We see a divergence across sectors of the economy. The manufacturing sector, on the one hand, is still working through a backlog of orders, but its prospects are worsening. On the other hand, in the meantime, the service sector remains resilient, vibrant, especially owing to the reopening of the economy after the pandemic. And you must have received a recto verso page that describes for you some of the key characteristics of the current situation. And you see the difference and the divergence between manufacturing and services. Household incomes are benefiting from fiscal support measures and the strength of the labor market, with the unemployment rate having fallen to a new historical low of 6.5% for the euro area. Looking at inflation, headline inflation has declined from its October peak and stood at 6.1% in May, according to Eurostat's flash estimate. While base effects have led to some variation in energy inflation in recent months, the rate declined to minus 1.7% in May. Food inflation remains elevated, but is decreasing and stood at 12.5% in May, down from 13.5% in May. Price pressures overall remain strong. Inflation excluding energy and food that I have just mentioned, declined to 5.3% in May from 5.6% in April. That's what we call core inflation. Upside pressures on both headline and core inflation are still coming from the pass-through of past energy costs increases and supply bottlenecks, which are nonetheless expected to fade gradually over time. The latest available data suggests that indicators of underlying inflationary pressures remain high. And although some are showing signs of moderation, there is no clear evidence that underlying inflation has peaked. Wage pressures have strengthened further as employees recoup some of the purchasing power they have lost as a result of high inflation. Moreover, in some sectors, firms have been able to increase their profits on the back of mismatches between supply and demand and the uncertainty created by high and volatile inflation. So what has been the ECB's monetary policy in that context? High inflation is putting a strain on people living in the euro area. As energy inflation, which imposed a notable burden on low-income households, declines, the inflation differential between low and high-income consumers starts to fade away. Nevertheless, high food inflation continues to weigh on low-income households in particular. And we at the Central Bank and within the Eurosystem at large are fully committed and determined to fighting inflation and to achieve a timely return of inflation to our 2% medium-term target. This commitment to price stability contributes to economic growth and employment in the medium term and hence to reducing inequality. In the light of the ongoing high inflation pressures, in our May meeting, we decided to raise the 3 key ECB interest rates by 25 basis points. We also announced that we expect to discontinue the reinvestment under the asset purchase programme as of July 2023. Our rate hikes are being transmitted forcefully to financing conditions for both firms and households, as can be seen in rising lending rates and falling lending volumes. At the same time, the full effects of our monetary policy measures are starting to materialize. Recent ECB staff analysis indicates that the effects of monetary policy tightening on real activity and inflation can be expected to strengthen in the coming years, but our assessment is surrounded by significant uncertainty. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our policy rate decisions will continue to be based on our assessment of the inflation outlook in the light of the incoming economic and financial data, on the dynamics of underlying inflation, and on the strength of monetary policy transmissions. Now, as you have requested, let me discuss the financial stability outlook. Financial stability is a precondition for price stability and vice versa. Financial stability in the euro area has proved robust so far, but we continue to assess possible risks, taking into account a wide range of indicators. They are mentioned in the 2 pages that you have received as well. Euro area banks' exposure to the recent banking sector stress, which arose in other regions than the euro area, has been limited. but challenges to funding and asset quality may weigh on future profitability. More broadly, as financing conditions tighten, we will gain more insight into the resilience of euro area firms, households, and banks. The medium-term orientation of our monetary policy strategy allows us to consider financial stability in monetary policy decisions if this supports the pursuit of price stability. Conversely, price stability remains as crucial as ever for durably preserving financial stability, and we do not see a trade-off between financial stability and price stability in the euro area. Over time, the pursuit of price stability through monetary policy and of financial stability primarily through macroprudential policy are complementary. In addition, the ECB has the tools to provide liquidity to the euro area financial system if needed to preserve financial stability and the smooth transmission of monetary policy. We remain committed to price stability, and to support financial stability, it is essential that you, as co-legislators, make tangible progress towards completing the banking union and that you strengthen regulatory policies to further enhance the resilience of the euro area financial sector. To conclude, in 1998, 25 years ago, former ECB Willem Duisenberg stressed that the European system of central banks should be open, transparent, and accountable, noting that the most important challenge for the ESCB is to win the confidence of the citizens of Europe. 25 years later, this is still an important challenge, and we are working hard to further foster trust in our institution. But the ECB cannot do this alone. Today's dialogue with you, who represent the people of Europe, is essential to that endeavor. And this is why I'm also, like your chair, delighted that we just signed, together with President Metsola, an exchange of letters between our two institutions, the European Central Bank and the European Parliament. Building on our close and fruitful dialogue over the past 25 years, this exchange of letters will allow us to better structure our interactions and facilitate effective cooperation. At this point, I would like to really pay tribute to your chair, who is really largely accountable for the success of this endeavor. This exchange of letters owes a lot to her. So thank you, Madam Chair. Together, we must do all we can to keep listening and responding to the concerns of the European people. With that, I thank you, and I stand ready to take your questions.
Thank you. Thank you, President Lagarde.